I think I'll make a start, and those who join us afterwards, I'm sure will be able to keep up with the flavour, because we are going to have a lot to do. So, welcome everybody, and to this BHP webinar on preparing for 2021. If we just set the scene a little bit here. In this webinar, we're going to try and cover what we believe are the essential topics for the year ahead. We probably won't get everything because there's never enough time, but we hope we've got the major ones. We'll try and cover the headlines for each section and then have a sort of Q&A session towards the end. We'll also input some snap polls so we can take the feel of the audience and the webinar. So anything that you want to add to the chat as we move along, please do, which we'll try and capture at the end, but we just might be able to answer them. You never know. It will be good. So just moving on then. So who we are. I'll be rude and introduce myself first, so forgive me. My name is Paul Blackman. I'm a business improvement consultant and a member of the BHP consultancy team. I specialise in all forms of operational activity, including the process measurement techniques and growth across manufacturing, retail and logistics. So having spent many years in senior positions in business in the UK and Europe, dealing with such a range of business types, I now share my experience to assist business to become both effective and sustainable. I certainly understand the challenges faced by business, but I have confidence that the current situation is both manageable and be overcome by business first and foremost. So there we are. So gentlemen, please introduce yourselves.
So I'm Dean Pearson. I'm a tax partner at BHP, mainly specialising in business taxes. I advise family and owner-managed businesses, and one of my main responsibilities is the provision of our innovation taxes offering, which includes things like patent box and research and development credits. And I'll introduce you to Jamie now.
Thank you, Dean. So my name's James Houseman. I'm a senior tax manager in the Leeds office. I've been at BHP for about a month now. Prior to that, I worked in industry. I held a couple of roles at McLaren Automotive Limited. Namely the tax manager. I was tax manager there for 3 years, and I managed all taxes, so both direct and indirect and customs across a £1 billion turnover group. I guess I'm on the call today because I've got expertise with Brexit and how a large company like McLaren was preparing for it, and potentially there might be some learnings that I've garnered from that which I can help you guys with. So hello.
Good afternoon, everyone. My name is Kevin Davis. I'm a partner in the corporate finance team at BHP. I've been at BHP for nearly 20 years now, so quite a long time. And our focus in the corporate finance team is really change events within businesses. So some form of change of ownership through management buyout or sale of a business, and in a lot of cases that will involve some form of fundraising or investment, which is going to be a big part, I think, of the next 6 to 12 months.
Okay, thank you, gentlemen. That was nice and concise. So if we move along and we consider what we believe the challenge to be, what we're going to try and cover, our view at BHP is that the year ahead will be certainly eventful, but not really gloom and doom. Yeah, some bumps in the road, but the direction is certainly forward. But for many, the business journey will be over new ground. If we start our sort of journey of our thinking, we thought we'd have a bit of a scene set of the economic overview. There's quite a few points in here of which let's see how we get on. So view is that midpoint 2021 is forecast to see normal levels of activity being restored. That'll be interesting. Investments will be sensible against business growth and market repositioning as the changes from Brexit become apparent. Consumer spending will strengthen, but possibly stroke probably more into a mixture of luxury stroke feel good and home type improvements. The working patterns for many of us will have changed and continue to change as the economy defines its key drivers. Certainly there's a big nod to Brexit and every other permutation there. The need for retaining business premises on the same basis, though, will need some careful review. So some points there. M&A activity is set to be in review for many areas of business, but we would suggest it's not limited to entrepreneurs or those with high liquidity. There's going to be quite a few takes there. There's also, for business, potential higher costs due to the changing trading patterns, which are at best unknown. Therefore, some smart thinking on effectivity and business control will need to be developed to match the opportunity. Taxation changes certainly will take effect, and thankfully we've got a taxation expert with us. Planning and consideration of trading models, we suggest, will assist in gaining most benefit. So, nearly there. The number of challenges brought about by Brexit, both financial and procedural, will be, we believe, considerable. So add that all together and we feel that flexibility will be required to embrace changes as they arise. We might define that as saying fortune perhaps favours the brave. However, understanding implications quickly will be absolutely essential. So there's quite a number of points there. So I think what I'll do is I'll hand over to our experts and ask them to comment around the whole area of what they feel is cash and asset build. So gentlemen, if I just throw it over to you to interject.
Sure. Do you want to? I picked that up in the first instance. I think. I think it's an interesting one. It's where businesses, quite rightly, when lockdown started, business owners and management teams were focused directly on the business, head down, sorting issues and focused on the here and now. I think since then there's been a bit of a holding pattern, whilst government intervention and support schemes have kicked in, and businesses have supported themselves with those. I think what we're seeing now through conversations with a lot of clients is that people are starting to get their heads up a little bit more, and now not just looking at what does the rest of 2020 look like, but what does 2021 look like and beyond. So people are starting to look beyond what was in the short term a complete unknown. I think we're all starting to settle into a new bit of normal. I know in our business we're starting to get people back to offices and back out to clients where it's safe, and everybody feels comfortable in doing it. That's the process we're going through, and it's no different for our clients. So looking at how to sort of protect that balance sheet and cash and asset build over the next months and into next year, I think we can look at it from a corporate point of view and from a personal point of view. So from a corporate point of view, certainly big business, I think there's quite a lot of evidence over recent weeks and months that they've been in balance sheet protection mode. We've seen investment programs being postponed, halted and held back. We've seen that filter through down into our clients and our client space of the SME market, and what has that translated into for our clients? More difficult for them to protect themselves in the same sorts of ways, but there's certainly been bits of restructuring that clients have done to move valuable assets out from groups or move group structuring around so that they're better positioned to take advantage of what will hopefully be a better return to normal through the course of next year. And I think, Dean, you've been involved in a number of exercises in moving business groups around and how that's worked.
Yeah, I mean, we're always having conversations with our clients about how their balance sheet looks, what valuable assets they've got, and of course what inherent trading risks they have. And in the last 6 months, it's sharpened everybody's focus that these inherent risks can actually come to pass. I think there's been a more sharpened focus now on, keeping what people have earned and what they've got, and the ways that some of these things can be ring fenced and protected. So we've looked at obviously using groups to split up trading activities or to split up assets and just really get good housekeeping in order in terms of what people have got in their business structures.
Yeah.
But also there'll also be some people that have probably had a lot of time to think and maybe sharpen their focus on whether they want to cash their chips in now or whether they want to continue with the business for the next 3, 4, 5 years. Yeah. So there's been quite a lot of conversations about whether it's time to pass down the business to the next generation, things like that. So those conversations have heightened somewhat in the last 6 months.
Dean, picking up what you were saying, which I've said, I find it very interesting. Do you feel there's going to be more on the deferring of tax and more on the planning of tax going forward for 2021?
I think that's already started, Paul. So, as Kevin sort of alluded to earlier, a lot of it was business protection mode. And the first thing that people needed to do was stop cash going out of the business and protect that cash burn. So, and one of the main things was obviously taxation liabilities, VAT liabilities and things like that. So we've done a lot of work recently on obviously managing that flow of cash, and also looking at what the accounts up to maybe early 2021 look like, so we can manage how tax losses look against the profitability that's been recorded up to say March before it all kicked off. Mm-hmm. The last thing sort of a lot of our clients want to do is pay a big tax bill now to then have to reclaim it back in a year's time. So we're looking at ways of managing that so we can bring those losses into focus and manage the flow of cash out.
No, it's a very good point.
The R&D claims and things like that bring a cash flow in as well.
Are HMRC being helpful, Dean? What's your experience of that? Are they being understanding? They're letting, organising time to pay arrangements, those sorts of things?
Well, certainly in the first 3 months, it was, they defer nearly everything that they were asked. When it got to sort of June, July time, then that sort of concessionary basis ended, and things like pay as you earn were having to be arranged on a more formal basis. And they're always looking at it on individual circumstances, but of course I think they're still going to be more amenable these days than what they were in 2019, for example, because
that's a very good point.
It's about preserving businesses and trying to help them to survive and thrive.
I think it's fair to say, yes, HMRC do often get bashed, but they're not always unfair. If we look at this though, do we feel that it impacts each area the same, or is there specific areas that are differently impacted?
In what way, Paul?
Well, we have on the call today people from various sort of sectors, so I think it's worth just touching at one of the things that, for example, the manufacturing engineering area. Some of those sort of companies have had quite a high sort of problem recently, to say the least. We know that some of the people in the retail chain have had more than their fair share of pain, but then there's going to be, the rebalancing of things. So if we look, for example, at something like Jamie was touching on his experience. Things like the aerospace industry, I read that there's quite a lot of changes there. So is there any relevance to just pick that up, just to qualify?
I can give you my experience.
Yeah, please.
Where you mentioned it earlier. Things have been delayed, so we had car projects that were pushed back, canned, and as a result, there were large layoffs. Nearly a quarter of the workforce was laid off from McLaren. Yeah, it's a difficult environment. These big, large, capital-intensive projects which require a lot of pipeline. Companies aren't forking out for them. I mean, things like R&D help there because you start getting cash in before you actually start earning from it. But that only goes 12% of the way, or if it's RDEC, it's even less. So it's difficult, difficult investment environment, I think.
Okay.
I think we've seeing clients in the aerospace supply chain that they've been having order books to unwind over the last few months, and they are now starting to see those order books starting to drop off because they've worked their way through them. I think what a number of trying to do is move into different areas, so moving the business more focused on defense, say, rather than aerospace industry. Now that's not going to work for all, but it's certainly helping. It's certainly helping a number of our clients and giving them some cash protection whilst they move into what will be probably a difficult last quarter of the year.
I think tax policy is going to have a lot to say about this, and of course we're scheduled to have a budget early November. We've had some interim measures, obviously, in the last 6 months, and read a short summer statement, which was a lot of it was about incentives to try and get people to be set on the Kickstart scheme, which will kick in November, where you get subsidised places for 16 to 24-year-olds. So there's things like that, but also I think there's got to be some incentives for investment. The annual investment allowance is due to reduce to 200,000 from $1 million on the 1st of January. So if people are planning sort of capital projects, there's that uncertainty about the tax relief that they're going to get on it. But I'd be really surprised if that was left as it is. I think there will be some incentives in the next budget to get people spending and getting their businesses sort of ready for the next phase and investing in technology. So I think tax policy will have a lot to say about it in the next budget.
That's very.
And that ties in a little bit to the funding environment, and there's been a lot of narrative around CBILS over the last 4 or 5 months. Initially, that was effectively a rescue package for businesses to shore up cash. What it's morphed into over time is a way for businesses who aren't necessarily in danger of running out of cash anytime in the immediate future to get themselves some additional headroom running into the rest of this year and into next year. And we've seen a number of businesses take advantage of that. So knowing there's going to be a level of uncertainty, but also knowing that there's likely to be opportunities out there through the course of next year, take that extra headroom now, and it's there for when you need it later down the line.
I think, Kevin, that's a really interesting point. So the moral there is perhaps take the debt and then repay it if you don't need to use it. But
absolutely.
I think it needs to be perhaps balanced with the idea that your working capital position as a business must always be as strong as you can make it. And if you are propping it up with a CBIL, for example, you need to really understand the resilience and strength of your business without it.
Yeah. Now, there's a timetable issue with CBILS in that applications have got to be in within the next couple of weeks, and I think they've extended the deadline for getting cash out the door to the end of November, so an extra couple of months. So there's a small window of opportunity available at the moment, but
well, there's an obvious point there. Anyone who's unclear on what to do, the guys are on the call who can help. Okay.
Yeah.
So not to go up 10.
Yeah.
Okay. So are we seeing that we believe that Sybil's is still a thing that is of benefit to people? Would we be getting behind it?
Absolutely. You know, what will replace it is difficult to say. It's likely that there won't be a direct replacement beyond 31st of December when we leave Europe, when Brexit, you know, officially happens. So EFG money won't be there. So there's unlikely to be a you know, Sybil's 2 to continue. But I guess that's tempered against the funding environment in general, which after the last recession in 2008, liquidity was just all but dried up. You know, the banks' balance sheets were shot, and getting funding was extremely difficult. As we sit here now, the funding market is very liquid, and there's a lot of funders out there looking to get cash out the door, and that comes from largely the number that are out there that have developed and come along since 2008. So all the challenger banks and the alternative lenders that are out there. There's a lot of choice at the moment.
Okay. Just a general point for our audience. Anyone who wants to ask any questions, there is the chat options there. So please use it. Okay. We touched on in our sort of session a little bit about acquisition opportunities in the M&A market. There's a lot of different thinking on that. You know, some people would say, you know, a good time to do an M&A is in a distressed state. Others would say other. What's the view of the experts in the call?
We've seen a gradual pickup in clients asking or having opportunities come across their desk in relation to acquisition opportunities over the course of probably the last 6 to 8 weeks. So for the first few months post March, there was next to nothing. That has since picked up, and we will expect it to over the course of the next 2, 3, 4 months, which will give those businesses with good balance sheets and the appetite to look at acquisitions and possibly the cash on the balance sheet, but also the funding capacity to be able to go out and buy these businesses, and they will undoubtedly pick up businesses that for a price that they wouldn't normally have got. So there's quite a lot of conversation and discussion around identifying the right types of businesses for making acquisitions.
No, very interesting. Do we feel that we're going to see a growth then in distressed sales, or do we feel not?
I think we haven't seen it yet, and you know, that's partly down to this holding pattern we're in and the government support. But I think everyone expects it to come through, and it's likely to, like I said, over the next 2 to 3 months. So there's going to be more activity in that area. Yeah.
Okay, so a number of the people on the call are likely to be business directors. Do we feel there's anything that we need to just comment on relevance for directors at the moment?
Well, I think you know, the insolvency regulations, whilst not being an insolvency expert, they were relaxed post lockdown, and I think there is some talk of them continuing into the end of this year. So we're unlikely to see a plethora, I think, of creditors, you know, taking businesses under until later in the year, which will give those businesses with an appetite to acquire and you know, build their business an opportunity over the next couple of months.
No, it's very, very true to say that there'll be many businesses who just decide they want to sell, even though they're not in a distressed state. They might just come to that.
Absolutely. And I think coming on to having looked at the sort of the corporate angle, Dean's touched on it. That it's the personal angle as well. I think that there'll be quite a number of business owners out there who will have felt the shock of COVID, and will perhaps think that their investment, their what they've built over what could be many years, is perhaps not as protected as they thought it was.
I think what you're also finding is that there's obviously there's a deficit to fund, and there's going to be likely to be tax rises in the short to medium term, and so there's quite a lot of focus from business owners that they might want to, like I say, cash the chips in now. Entrepreneurs Relief got cut in the last budget from a lifetime limit of 10 million to $1 million, and we do know there's a review of CGT, capital gains tax, being considered. Most people would consider that capital gains tax is only going to go up. So people are thinking about tax as well as the general environment when they're thinking about what they're planning. So we've seen quite a few of business disposals being done internally as well as externally, where especially where the company's got enough funds to be able to facilitate that.
No, it's a good point. I suppose in relation to M&A activity as well, many businesses will be looking at what they do and what they offer, might actually decide that their supply chain might do some strengthening by actually having a stronger supply base that's actually tied to themselves. Yeah. So the M&A activity actually might be more strategic than before for those who have the cash. But I think this is a watch this space, isn't it?
It is.
So if we move on to import and export implications, which we touched on, I'll take the liberty of doing a bit of a scene set, if I may. We've seen nationally, there's a trade deal now with Japan, which is arguably the first major deal of the round. It's not really an area that I think many people in UK business actually have a lot of experience with, but it's a real opportunity for many. On a personal basis, having dealt with Japanese companies for a number of years, as both a supplier and a customer, I would say this: they are more pro-UK than is realised, and extremely straightforward to deal with, and very open to sort of discussion. So that links very much to the government drive and the view of, I think, most business, that growth is going to come from export in some shape or form. So this key economic opportunity has its own complexities, and thankfully we've got Jamie on the call. None are impossible to navigate through if you take your time, and certainly what I would say as what I do is check before you act. There are experts here, we can all do it, but take the advice, please, everybody. Check before you act, because once you've done it, you have done it. So I'm personally hopeful we're going to see a lot more trade deals, and I have to give a bit of credit to the DIT. They are doing well on this, but it never can be fast enough. So Brexit, yes, it's an unknown, but my take on this business will find a way through, and reality will ensure it does. So bit of complex planning. We have talks on Monday nationally, which will limp on, I'm sure, but I think a deal is in all interest. So Jamie, you're the expert here. So what would you like to talk to us about with import-export?
So what I thought I'd do is just highlight things that are going to change when we leave the EU. So the first one is possibly the simplest one, and that'll be VAT. So from the 1st of January, they're going to introduce something called VAT postponement, which is very similar to how you account for VAT on things you buy from the EU at the minute. So it works two ways now. If you import something from, say, the US or Japan, when the goods come in, you pay import VAT at the border, which means you've got to pay the cash while it's sat at customs. That's going to stop. So for whether you're importing things from Germany or from Japan or wherever, you don't have to pay any VAT at the border, which is great because that's a cash flow benefit and it also speeds things up. So that'll come in on the 1st of January. There's nothing really you need to do for it. You might, if you have a deferment account at the minute, you could possibly look at reducing your deferment account limit. Which typically deferment accounts sit on top of your bank overdraft, so you could free up a bit of banking headroom by reducing the VAT element of that. The more complicated thing that's going to change are duties. So at the minute, we're in the transition period and nothing's really changed with regards to movements to goods to the EU. So there's free movement of goods, you can move things around with few exceptions without much trouble. However, from the 1st of January, there'll be a hard border, which means that if you're bringing something in or sending something out to mainland Europe, then you're going to have to lodge an import declaration and follow some compliance. So when I mean compliance, what that is typically it's a form. Both import and exports, you submit a form which has a bit of basic information on about what your goods are, who they're coming from, what you're going to use them for, those sorts of things. And ultimately, you put something on there called a commodity code, which classifies, it basically says what your goods are. And that's what they derive the customs duty from. So from 1st of January, as it stands, we don't have a deal with the EU. Anything coming in will be liable to import duty. Now, there isn't a fixed rate. It varies. Some car parts, for example, are 4% import duty. Cotton was one I looked at earlier on. That was 8%. Medicines at 0%. So things vary. So one thing you're going to have to think about is, am I going to have to worry about import duty on the parts or the goods that I'm bringing in from the EU? There's a few other complexities that you need to think about, and this is actually what goes on the form. So you're going to have to think about how things are valued. That's really straightforward if you're buying things from people or selling things to people. But if you're getting things such as samples or prototypes, or if you're moving your own goods around, what value are you going to put on there? Because in theory, if you're sending something to Germany for a trade show without prior preparation, you might have to pay import duty into Germany on that. The next thing is your classification, what commodity code are you going to use? And then the more complicated one is origin. So Paul touched on the free trade agreement with Japan that we've recently agreed. So what that states is if something is of Japanese origin, if it's made in Japan, we'll pay a preferential rate of import duty on it. But what happens if if you buy something from a German supplier that's made in Japan, what you're going to do there, you need to know where things are coming from. And where you also might see this is if you supply into a big manufacturer. Certainly when I was at McLaren, I was writing to my suppliers and going, what is the origin of your parts? And some of them were small one-man bands, and they had no idea what was on about. So if you get any questions from customers on what your origin is, please reach out and we can help you. So that's the sort of compliancy thing. Also, what you've got to think about there is lodging your import entry. Typically, you need an agent to do that. So, and they will charge you for it. So I think there's probably going to be a big rush for agents come 1st of January and then start of next July when the transitional simplified procedures end. So what I suggest there is that you start speaking to logistics providers now and saying, are you able to do my import and export entries and agree a fee with them, because they might see it as an opportunity to put the costs up. And also capacity is one thing they might not be able to. So you could be stuck with parts waiting to go and no means of actually exporting them. So that's the sort of the UK side. One thing I also wanted to touch on was the EU side. And one thing to be wary of are your Incoterms. So for those who don't know, an Incoterm is, it basically dictates who does what in the supply chain. And it goes, there's sort of a spectrum. You can have X works, which means the buyer has to do absolutely everything. So as soon as that part is made, it's pushed out the door at your supplier's factory and that becomes yours. So if that's in Germany, it is your responsibility to export that out of Germany and submit an export declaration. Now, in certain places, that's very difficult because you need a physical presence. So Italy, for example, you would need an EU entity with an EU VAT number, which a UK VAT number won't suffice anymore to actually move goods out. So be mindful there that there's a risk of things getting stuck at borders. The other thing, so the other end of the spectrum, you have an Incoterm, which is a DDP, or delivered duty paid, which means the supplier does absolutely everything. They're responsible for everything, all the taxes, and basically turns up to your door and it's yours and you don't have to do anything. So if you have an EU supplier and you've currently got them signed up to DDP, then they're going to have to pay UK import duty and UK VAT, and they're going to need a UK VAT registration to do that, which in my experience, some EU suppliers have no idea about, and I guess the risk there is that, again, you have things stuck at borders, and if you're operating a just-in-time supply chain, that's going to lead to impacts on your production. So, you know, these sort of really technical points could have a knock-on impact that ultimately hits your bottom line because you can't make things. So that's sort of, there were the key points I wanted to touch on. It's a really complicated area. And
Jamie, I think you've covered the complexity extremely well. Something just to touch on, I hope. You mentioned Incoterms, and for those who, as you say, are not used to them, they should be an integral part of your supply agreements anyway. Yeah. It's going to be incredibly important going forward that everyone looks at their supply agreements, both inbound and outbound, because it's going to derive very much where you are on the let's say the taxation route, the ability to do the physical activity. So I can't stress it enough. Review your supply agreements inbound and outbound, and certainly consult carefully on what you need to include, because as Jamie's really touched on it very well, it's going to be complicated, and the moment you find out does not want to be when it's too late. If you're waiting for the goods, you're waiting for the goods because you want them, aren't you?
And historically, supplier agreements, where a lot of businesses don't have them, and if you don't, it's time to have a conversation with your suppliers. But with European ones, it didn't matter. The Incoterms dictated who did delivery and insurance, really, not the tax bit.
It was easy.
So yeah.
Yeah, it was easy. No, thank you. We've terrified everyone with import and export implications, of which everyone will be totally traumatized. Let's look at something else then. Let's have a look at what joins all these things together we've been talking about, which we've sort of euphemistically called control and decision making. So I'll try and scene set a little bit again so our guys can pick it up. I would say that the key bit here for all business is it's got to be effective in its decision making, and that to me means doing the right thing. So that is a real top level leadership challenge onto, you know, what will businesses really need to do to keep them where they want to be against their sort of strategic plans and all the other things, taking into account the financial points as said. So I think if we don't look at that together properly as business, you know, no matter how efficiently you are efficient doing the wrong thing, you know, and that's the bit that we're all trying to avoid. So 2021, in our view, is going to be about very slick processes, as Jamie was saying about import-export, for example. Looking at business productivity properly, it is a national nightmare. I'm not going to try and go around that loop too much, but we do realise, I think, all of us, that unless we increase our productivity, we're not going to get the increase in margin and the flexibility that business is going to need to weather this particular storm and set of changes. So taking that into account, many businesses certainly might feel under pressure to change their strategy. I would suggest this is never a quick fix, and consideration should be given to all of your tactical considerations first before you want to look at changing strategy. It always takes much longer than you think. Your customers very much are still there, but they will need different motivations, as we've touched on. So please think carefully. A point, though, to consider is to get the flexibility and agility into your business, particularly relationships. And as an open question, are you working closely enough with your customers and suppliers? Because if you are not going to maximize that opportunity that is there for you. So there'll be a change in the trading patterns, yeah, but there's a very real need to examine all you do for both relevance and profitability. Now, as a sort of the financial side of that is one thing, but the key action is to actually all of us in business to face that we need to look at it carefully. So if I throw it over, let me just put some points there. So we've got bits on cash to consider, decision making, we've got employee engagement, how do we get our productivity up? And I suppose with engagement with the financial team closer than ever before. And I would say the importance of clean information and perhaps a transition to more digital approaches. But if I throw that open to the guys on the call to throw in, so if you'd like to pick that one up.
Yeah, it's interesting, isn't it? Because, we've all been forced into making quick decisions and slick decisions and maintaining our productivity and trying to improve it over the last few months. It's almost been a learning curve for everyone on that front. So I see this almost as business trying to continue on that path, really. And you're right, picking up things like information and having timely information. I think that those businesses that don't have that will have suffered a little bit over the last few months, and those that have good quality information, timely, good connection with their finance team, have been able to make quick decisions, whether that be from a funding point of view or a strategy, customer, supplier point of view. It all ties in. I
think the point about quick decisions, Kevin, is well made, but I think we need to emphasise the quality.
Yeah.
Needs to be massively understood, and you've touched it. The information and the quality of that information is going to be key, always has been, but massively more so as we go into needing to make faster, better decisions. We suggest.
I'm a big fan of sort of a scientific approach to this. So, in making an investment decision, and it's all about allocating your capital in the most effective way possible. And how do you do that? Do you have a methodology for making these decisions? And also, once you've made a decision, do you have the feedback loop to check that it's the right thing? Are you learning from your mistakes in a way, or are you flying by the seat of your pants and possibly making the wrong decisions? One thing I experienced was that happened occasionally. There'd be a knee-jerk reaction, do something, but often sitting back and just having a little think about it and going, is this the most sensible approach? Would have saved a lot of money.
Should we talk about taxation and innovation, and that tees Dean up neatly?
Yeah, I mean, we've already touched upon the fact there's meant to be another budget in November. There's a bit of uncertainty about that as to whether we might get a second spike of the coronavirus and whether that might end up being put back. Because everything we've had in the last 6 months has been to support and react against the economic changes we've seen as a result of COVID. We've also got the spectre of Brexit fully kicking in as well. So the UK, it's a balance between funding the massive hole in the economy and in the treasury, from funding all the support for everybody, whilst trying to still attract and retain innovative businesses in the UK. So, I don't see any changes, for example, to the R&D regime other than positive ones, I would imagine. The message is still going to want to be that the UK is the place to do business, and it's the place for new technology and innovation. Once the sort of EU shackles come off, it may be that scheme can be extended or improved, and time will tell on that, but that's got to be balanced off with, balancing the exchequer. So there's some decisions to be made there, and it'd be interesting to see how it goes. So yeah, I think there will be there'll be an incentive to get people to invest and innovate, but that's got to be balanced. There's got to be a tax take at some point, which I think was touched upon by Rishi right at the beginning, in that he might look to, for example, equalise self-employed people with employed people because they were getting coronavirus support. The capital gains tax regime might be reviewed. There's always been an underlying possibility that inheritance tax might be reviewed. So it could be that because the whole world has changed, it might be a time for a completely new way to look at tax. But I think it may be that the November budget might be a bit early for that, given that we don't know how the economy and life is going to look, is my view. But yeah, I don't think there's a short-term increase in corporation tax coming, but I think eventually that might be something on the horizon.
And on the R&D front, Dean, would it be fair to say that there'll be a lot of businesses out there that have innovated and changed the way they've done things and changed the way they've produced products or produced new products over the last 4 or 5 months, and it's probably worth them re-looking at that, isn't it?
Yeah, I think as businesses, even ourselves, we've all wanted to change, and we're all a bit slow to do it. But this whole thing has forced us into quick change and adapting. And I think certainly in certain types of business, manufacturing and things like that, there has to be new and more efficient ways to produce the product, or to satisfy the market, whether it's a new product or a different type of a different use for the product. So yeah, I'm seeing quite a lot of things on, a lot of conversations with people about how their innovation and their strategy looks going forward from the beginning of 2020 right through to obviously into 2021. We're looking forward at how that, not only how do they adapt, but what payback they're going to get for their R&D and innovation at the same time.
Interesting. So I suppose looking at the time, it seems a terrible way to say it, but we do have to be mindful of this. I think rounding all this up, it's been very, very interesting, and the depth and breadth has hopefully come out. We do have a question, but before we start on any questions, very important, thank you to the audience for taking part. Thank you very much to the panelists, but we would also ask everyone if you could give us a little bit of feedback, which will certainly be organised, but we would also, all of us, like to be able to offer out a bit of support to you all with a bit of the virtual coffee approach. We have old clients, we have new clients, we have people who have not even considered being a client. The whole point is we're here to support you. So please reach out and do that. So if I take a look at the question there, I think can panelists see the question from Adam Binns? Thank you, Adam. So which of you gents would like to kick that one off?
I think interestingly, this is about what sort of range of sectors are represented on the webinar in terms of, I think, respondents to the survey. I don't know if I actually have that information to hand.
Yeah. I can help you. We have some manufacturers, we have some service providers, we have some retailers, we have some sort of
professional services represented.
Yeah, we have a good gamut. So across the economy, we are well represented, and thank you everyone for doing so.
Yeah, I mean, I think from my experience, and it's a very generalised look at it, is we've had, we're obviously talking about people being affected by what's happened in the last 6 months. I've got quite a big core of clients who have done really well in the last 6 months as well, especially those who've been able to react and seize the opportunity from the changes that have taken place. So yeah, we've had a very significant client base that have suffered and are looking to recover, but also we've had quite a few clients that have thrived through this period as well.
I think, Dean, that's the point, isn't it? It's very polarised, isn't it? There's those that have done extremely badly, and some surprisingly have done very well. But something that's come out of this is those who've been innovative in their thinking and approach have actually found a way through this, and that, I think, touches on our considered belief that business will find a way through this problem, whatever. So I hope, Adam, that's tried to cover your point. We do seem a bit low on questions. Maybe we've sort of sent everyone into a stupor, and for that we apologise. But I think the thing I would just sort of wrap up in saying here is that there's no wrong time to ask questions of your advisory bodies, whether it's us or it's others. But the clever thing is to ask the question, not believe you know the answer. You know, because we're in such a position of change that all of us in business are likely to be quite surprised as we go forward. So that's my view of it. I don't know if anyone else has a different view.
Yeah, and I think the other thing I'd say is if you're not comfortable or you've not thought of a question you want to ask now, is that we're all quite happy to answer those questions on a one-on-one basis to the best of our ability. You know, we're always open for a chat, and we're very available.
No, that's good. So okay, so I'd like to bring this to a close, but please give us some feedback, everybody. I hope you're good. Thank you. That's good. Certainly, thank you, everybody, and I look forward to us doing it again.